Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41394 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. I was actually saying this is why I come to work days like this, where we get big deals like this, and you just can't help yourself but to dig in and chew on all these news. So let's get into Anglo-American. Drikus, starting off with you. Yeah, lots of questions actually on that. What do you make of Anglo and Tech's deal? Still value in Anglo. Is it a buy?
Yeah, I thought so before the merger. I think even more so now. I like the ratio. I like the merger of equals. I like where tech resources, where the resources are located. I like the resource split that Anglo and Tech will have after the acquisition. So as somebody that's already bullish these metals, no longer term, I do like the merger, and I do intend to hold Anglos for quite some time.
I mean, it's quite interesting because, I mean, investors, Anglo-American investors were excited about any merger at this point because when BHP was also going for Anglo, you'd see, you know, the share price rocketing. But just looking, and it's quite interesting, JP, because then it was a big company basically trying to swallow it and trying to force it to sell some assets. So would you say that this is a better deal, maybe a better match between Anglo and Tech?
Yes, I think, firstly, I'll remind you that Glencore tried to also take over Tech. What was it, about 2 years ago? So both these assets that were in play fended off their potential acquirers and then decided to tie the knot themselves. So it's an interesting story, and I do think that the combined entity is more attractive because they are focusing on copper. It really benefits the copper exposure, and they each have a big copper asset in South America that are adjacent to each other, the two assets. And they said that over and above the synergies that they expect in the next year or two, if you look a bit further out, there's some nice synergies that come from those two properties that are adjacent to each other as well. So it does make it more difficult for another acquirer to buy the combined entity because it's bigger.
Yeah.
But you still have the likes of Billiton, which is substantially bigger and probably wants more copper exposure. And Glencore, the share price of Glencore has come down a lot, but in a different environment, maybe Glencore itself might have another look at the combined entity. It might be too big for Glencore, but never say never. BHP Billiton might come back and look at the combined entity. So it takes away the immediate chance of a takeover by BHP Billiton, but it makes for a better company because of the clear focus on copper.
It's quite interesting that, I mean, you go into detail about BHP and Glencore that, yeah, maybe they might still be interested, but it might not be as easy. Because I was actually looking at the share prices, and I think Glencore was actually up. Billiton is down slightly on the day. I actually thought that we would have seen maybe more of a downward movement on Glencore, but we didn't. Does this deal then not, I guess, threaten investor sentiment in terms of what Glencore and BHP could do with this kind of change in the landscape, with this big copper producer coming in, Drikus?
Well, they're not going to produce new copper per se. It's not going to flood the market, you know, fundamentally in any way. It's just a more attractive entity, a de-risked entity, you know, versus buying them separately. So it's a de-risked entity, you know, and Anglo has been getting rid of some its more cyclical or riskier assets. I put that in quotation marks because I do not necessarily think it was the right move, but it looks attractive, more attractive and less risky to the market. and I don't think it's got anything to do necessarily with the competition.
Yeah.
I'm not sure why Glencore moved up.
Yeah.
Maybe it takes tech resources off the table for them. They won't make
Okay.
another bid for them.
Okay.
That might be part of it. And secondly, I think investors might be waking up to the idea that these assets look attractive. Glencore might be a suitable takeover target in their own right. I'm not sure the big shareholders would likely sell, but I do think that investors will look at mining assets differently after a big deal like this.
And actually, just talking about that, sure, Glencore has surged, but BHP is down almost 1%. And I'm wondering, JP, if this is maybe investors thinking that, okay, the copper crown jewel that BHP was going for, now there's absolutely no chance for them to get into it. And what are the chances then of BHP expanding their copper exposure at this point?
Yes, it potentially takes off the table one strategic option for BHP Billiton, and that is that they could have come back to take a second try at Anglo American.
Yeah.
And now that the combined entity is so much bigger, it will take probably some time before BHP might be in another position to try and look at this combined entity. But also it means that BHP Billiton will just need to get the best out of their current assets. They can't look for large M&A necessarily change their basket of commodities that they're exposed to, or they might look for smaller deals. So there's still some options for BHP Billiton. They still have significant iron ore exposure. This combined entity will still have iron ore as well. And that for me is the big question mark. What's going to happen to the iron ore market? Because China is slowing down. India is slowly but surely picking up, and in between that transition from China being the driver of the iron ore market to potentially India maybe being the driver of the iron ore market going forward, it's going to be interesting to see how that transition happens and if that supports the iron ore price or if iron ore falls back if India disappoints. So that will be a big portion of the BHP investment case going forward.
Yeah, all right. Well, as we're talking about Anglo, there's a question here on Valterra Platinum. What are the prospects for Valterra Platinum over the next 2 to 3 years? I guess can it continue this momentum that we've seen that's been a kind of broader upward movement in the PGM space, Drikus?
No, the movement that we've seen it for sub 500 Rand, where Anglo sold its first bunch, that's just unsustainable, the bounce that we've seen in 6 months. No, so no, a bit more than 6 months, excuse me. But still, it's this momentum can't continue. Can it be much higher in 2 to 3 years? I've got money in Anglo Plat that says so. So I do think that the platinum market is still in deficit. It will be for some time, and we need a much higher PGM basket for any new supply to come online.
Okay.
And I don't think the demand for internal combustion engines or for hybrids, which use more platinum per engine capacity, that's going to go away. EVs are not taking over as we thought it was a few years ago, or only a year ago for that matter. And there's a lot of other industrial demand for the PGM basket also, coming to the fore all the time. So I do think there's a future for PGMs, and supply is limited. It's concentrated mostly to Southern Africa and a few areas, and I think it's got a good future, especially at these prices. Might be due for a pullback. I'd wait before I get in if I'm not there already, but long term, I do think there's a future.
Yeah. Your thoughts on the prospects of Valterra Platinum, JP, over the next 2 to 3 years? And it's quite interesting because half of the market believes that these stocks are just for trading.
I'm probably in that half. So it all depends on the PGM basket price, and that can really go anywhere. So also the real big jump that we saw in all the platinum producers' share prices came after rhodium jump. And that is the big, it's a small metal, but it trades at a very high price. So it really drives the whole basket of the PGM basket. And because it's such a small part of the basket, it means that You just have a small change in the demand-supply balance of rhodium, and all of a sudden your basket price of the PGM basket changes a lot. So because of that sensitivity, I don't have a high degree of confidence in my forecast for the PGM basket. I agree with Drikus that the share prices have risen more than what the PGM basket would imply over the last 6 to 12 months.
Yeah.
So they are implying an even higher PGM basket price. And at the end of the day, because of this dynamic of the share prices of the mines being very much driven by the prices of the PGM metals themselves and being so difficult to forecast, it's for me a low conviction stock. And that's why I do say that when it comes to these types of commodities, they're more for trading than investing. There is a scenario 10 years from now, the PGM price is much higher, and therefore the share price of Valterra will be much higher. But there's also a scenario where the PGM price is similar to where it is today, and then the share price will be lower because costs will increase by inflation. So it's a difficult one to think about over the long term.
All right. Well, let's actually just call this first half the commodities first half, because it's all about commodities. This is on gold. Is New Gold or Harmony the better buy for a 5-year view? I'm not sure if this is the company or the ETF with New Gold, but your take, Drikus?
No, New Gold must be the ETF, right? GLDs.
Yeah.
So, yeah, look, the gold price have risen a lot. One of the bigger gold bulls on the show, but and I must tell you, to take some profits off the table.
Yeah.
Yes, have some gold exposure for if the US gets into a situation where they have to get into yield curve control, because that's actually what the market's trying to tell you.
Yeah.
So there's two things driving the gold price. The one is geopolitics. Central banks all over the world are buying this instead of US treasuries. As easy as that. That started about 10 years ago, actually. It's picked up speed, post the 2022 confiscation of the Russian reserves. And I don't see that going away. That's why you see gold drop, but, it consolidates quite quickly. And I'm actually surprised it broke out. And I'm not sure where it's going to consolidate, but I would take somewhere in this run. I'll take some of it off the table. In fact, we have already exited some miners. The miners are printing cash at the moment. Harmony, Goldfields, Anglo, all of them, because the input costs has also come down the last 12 months.
Yeah.
Energy prices are down, oil prices are down, diesel is down, cyanide is down. So they're printing cash. 5 years from now, 10 years from now, can we have a higher gold price?
Yeah.
Sure. It all depends on the dollar. And it's much less to do about the gold price. The gold doesn't change. If I hold one coin of gold in my hand, it's the same 10 years from now as one coin of gold. It's the price of the currency that we price it in that changes a lot. And that's bound to change a lot, I'm sure. I'm not bullish on the dollar. I'm very bearish on the dollar. And for that reason, I will continue to hold precious metals, which includes gold, in my portfolio. But take some profit at these, or near these levels at least.
Well, JP, just quickly, Drikus is talking about these miners printing cash, but Harmony not necessarily benefiting fully from the gold price because of their hedging strategy. So at this point, do you go for Harmony, the miner, or an ETF?
Yeah, so on that hedging, obviously when the price goes through the roof and they hedge, that's bad for them. But if the gold price should come down, and it even goes down lower than the floor at which they hedged, then potentially it's a good thing for them.
Yeah.
So, it's a tricky one, because some people like the gold miners if they hedge, as long as they hedge a very nice margin at the price they hedge, and others say, no, man, you're a mine, just focus on mining, don't worry about the price you sell at. So there's two camps in terms of how to think about that. But in terms of the actual question, between the two, I would prefer the actual gold ETF, the actual gold price. Over time, the gold price over the long term outperforms the miners. In the short term, the miners would outperform if the gold price rises sharply, which is exactly what has happened, let's call it the last three years. Then the gold miners outperform. But normally that outperformance is short term in nature, and ultimately the costs do catch up to the gold miners. So if you're thinking long term and you're deciding between the ETF or the miner, I would go for the ETF. Even though I agree with Drikus, the ETF price, the gold price, is very high at the moment.
Yeah, all right.
Yeah, of course, the third alternative is buying a royalty company. That's somewhere in between. That obviously they are linked to the revenue levels of most of the miners that they do business with, but they haven't got the same fixed cost structure that a miner would have. So the earnings are much less variable. And one of the typical ones maybe Franco-Nevada.
Yeah. Okay. All right, let's go into the property sector where we have a question going forward. Your view going forward relating to Growth Point and Redefine. These have actually been quite of interest to our viewers lately. Is there opportunity in property at this point, to JP?
Yes, I do think that property was maybe overly depressed in terms of people's perception of property and the prices of the real estate investment trusts just after COVID. They've slowly but surely trended upwards, the prices, and the fundamentals have gone sideways to slightly up. The fundamentals have not deteriorated further.
Okay.
And that's very good, because things could have been different, and we still have very anemic, very low growth in South Africa, which generally is not good for property. And our real rates are very high, which is also not good for property because it means your debt is quite expensive. But these property companies have done a reasonably good job in terms of mostly maintaining their distributions or even growing them slightly. Between the two companies you've mentioned, I prefer the Growth Point portfolio of properties. Specifically, I think the V&A Waterfront is a crown jewel in their portfolio. And they've got a new CEO coming in. Maybe they'll clean up some of their overseas exposures and maybe some of the smaller assets. And I generally would prefer it to Redefine, which last time I looked is also a bit higher geared.
Okay.
And I think in the current environment, again, we still have very high rates. I prefer a property company with a lower level of gearing. So between the two, my preference would be Growth Point.
Yeah, Drikus, would these be of interest to you in your portfolio, Growth Points and Redefine?
Yeah, we've been overweight properties for the last 3 or 4 years. I concur with Jean Pierre that they've been overly punished. At one stage, they were the darlings of a Reg 28 portfolio. People chased them because they tried to build more aggressive Reg 28 portfolios. These companies traded at quite steep premiums to their net asset values, and some of these companies, won't name names, reverted to a lot of financial engineering to keep the dividends on growing into a difficult economy, and that came collapsing down even before COVID. So a lot of investors have been hurt. Then came COVID, and I think what led to about 2021, 2022. A market drive for the picking. Obviously, interest rates then started increasing, and they were under pressure again. But in the last 3-4 years, a lot of them have rationalized their portfolios, consolidated, cleaned up the balance sheets, and that is continuing. And with a lot of discounters, we don't own Redefine or Growth Point at this stage, but I do think I won't stand in anybody's way buying them. We own a few others. And then secondly, it's they're bond proxies also. So long-term bond rates are dropping locally. It's still steep, as JP alluded to, but the Reserve Bank is working us down to a lower inflation expectation, structurally low inflation. They want to target 3%. I don't know if they're going to be able to do that within the current regulatory framework. But if they anchor inflation expectations closer to 3%, we might get lower risk premiums going forward. Let's say we might easily have a 5%, 6% interest rates going forward without generating inflation, because inflation expectations has been anchored lower. All of a sudden, the cost of capital is lower in the country, and structurally, you'll get a re-rating in the property sector, a quite substantial one from here.
All right. Gents, just a quick one. Retailers. Walmart says it's coming to SA. I don't know, how does that shape your view of the retail landscape in South Africa right now, especially considering the fact that Walmart says obviously it's coming with a low-cost strategy, where we've seen a lot of companies win because of that. JP?
I don't see it having a material impact. So obviously, Walmart owns the Massmart Group, which is now unlisted. And you can think a brand like Game, for instance, I don't know how much traction it has in the local market. So it'd be very easy for Walmart to come in and just rebrand a bunch of games and make them Walmart, and think that maybe the South African consumer might have a greater affinity to the Walmart brand rather than the game brand. I mean, it will be the same distribution and logistical channel to source the goods. And Massmart is already part of the Walmart group and benefit from plugging into their systems and their sourcing. So I don't think just because they put another name on the outside that all of a sudden everything inside is going to be 20% cheap and it's going to cause a price war. I don't see that happening. And it's also not, there's no incentive for Walmart to start a price war. So I don't think it's going to be too big a thing. It's similar to when Amazon, I would say, entered the country. What's it, last year?
Yeah.
And it hasn't really had an effect. People thought it might have this big effect, and it hasn't had an effect. So I think Walmart's entry will be something similar.
That's interesting. I mean, it's surprising to me because obviously of the fact that Massmart didn't do so great, and now you want to come in yourself into the country. Any thoughts on this, Drikus?
Yeah, I'm not sure whose market share they would target. If let's say they want to open new, storefronts, new retail space, who are they going to target? Is it going to be Shoprite? Low-end food, refrigerated foods, etc. I'm not sure whose market share they're going to target. Maybe they're looking at Shoprite and saying, those are some fat margins there for a retailer. Maybe we should get into that. I'm not sure, but I'm with JP. I think they've tried this before through Macro, doing a lot of fresh produce and frozen foods, etc. through Macro. It hasn't made a dent really in the market share of the other retailers, other food retailers at least. So no, I'm not sure.
Yeah.
This is the threat to the other ones.
Yeah.
No.
Okay, well, let's cross over stateside. Berkshire Hathaway, I've held Berkshire Hathaway long term. Lately, it is underperforming the S&P 500. Do you think it is time to switch? JP?
I think being an investment holding company with a lot of cash and having sold down some tech holdings is not the worst place to be. So, no, I would not be switching from Berkshire Hathaway into the S&P 500.
Okay.
I think I'd be very comfortable holding my Berkshire shares and not being in the S&P with its increased concentration in the biggest shares, and those biggest shares being increasingly exposed to technology. If you think about the semiconductor cycle that NVIDIA is exposed to, and a few of the others. So I would be very comfortable and I would sleep well if I had Berkshire Hathaway shares.
Well, if you decided to switch, Drikus, there's a question here. Which is better for 5-year view, S&P 500 or NASDAQ?
Do I have to choose?
No, you don't.
I mean short. I'll be short either. Yeah. Now I'm an active manager. I think I can outperform the S&P 500 or the Nasdaq. It's been difficult the last few years with the Nasdaq firing away, but for year to date, you're still down in euro terms in the S&P 500. It's touching new highs in dollar terms, but in euro terms, if you're outside investor, even in rand terms, it's barely touching its all-time highs. So we're actually doing much better on a JSE this year than in the S&P 500, and you're doing much better elsewhere, basically, than the S&P 500. But because we're so tuned into, the media and newspapers, etc., and X accounts, if you will, to the US markets, we think, the Nasdaq is firing away at the moment. But in euro terms, or in GBP terms, or even in rand terms, it looks like it's rolling over. So I'm not bullish on the S&P 500 or Nasdaq. But it might get bubbly. It's if you there was a lot of astute investors that were bearish in 1998, and stuff went on to double and double again in the next 2 years. I can't call these things, but I do think if you take a longer term view, a 10-year view, I do think active managers with proper diversification, worldwide diversification, in different industries, different asset classes, will outperform a more difficult environment that I think is coming over the next 10 years.
All right. Well, let's get into your stock picks. And as JP, you're talking about an investment holding company with a lot of cash. You are choosing Rainet today. And there's also a question here, is Rainet's future more clear or not? Buy now or wait a bit. But you are saying buy now.
Yes, or maybe you should have bought last week when Drikus chose it. So he chose it last week. I'm choosing it tonight. And basically, yes, in a bubbly market, potentially, I want cash, and not necessarily US dollars, but I know that Mr. Rupert likes to keep his cash in Swiss francs. I'd be quite comfortable with that. That cash has not come into Rainet yet. They are selling their pension corp stake, and they said they expect that to close early in 2026. So I don't expect any big changes, any announcements in Rainet's strategy until then.
Okay.
So you can hold your breath till 2026, and then you can start exhaling. And the question is anything going to change? Well, maybe nothing changes, but then at least you're buying a bunch of Swiss dollar cash at a discount. That's effectively what you're buying. Buying if you are paying the current share price for Rainet. It is going ex-div tomorrow, so don't be scared if you see a little share price drop tomorrow.
Okay.
But, the other scenario is that Mr. Rupert calls it a day. And he says, no, he's had enough with this investment holding company. He wants to play more golf and spend time on his wine farm. And if that is the case, then maybe it unwinds. We all get a special dividend, or maybe he does something else. So I think your downside is relatively limited. You have a lot of cash that is very safe, and you have some optionality on the upside. So buy it now and then wait for early 2026 to see what's going to happen.
All right. Well, since you chose Rainet last week, Drikus, can't do that again. And also JP's taken it. So where else are you seeing opportunity today?
Yeah, uranium. I've been a uranium bull for 5 years or longer. I can't remember. Made a lot of money in Cameco, but valuations look quite bubbly, if I can use that word again, lofty, if you will. So we've switched a large part of that into the physical stuff, into Sprot's vehicle, U.UN on the TSX, or U.U on the TSX, if you want it quoted in dollars, basically. Cameco themselves are short 8 to 9 million pounds just in the next few months. They have to go buy that in the spot market or find someone else to contract that. There's maybe a few million other pounds short that utilities must contract in the next few months. The window to contract this stuff is closing. Uranium at 70 odd bucks is not expensive by any means. It's a pretty small input into the larger, cost of operating a nuclear plant, and that's in a very supply constrained market, the demand side is very, very inelastic, and if it starts running, I don't know where it will stop.
All right. Well, we do have to stop there. Thank you so much for your time and for your analysis there, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Up next, The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.